Good evening, everybody, and a very warm welcome to our monthly webinar. We will take you through first the performance of the product, followed by the topic of the month, which basically gives you some perspective on private versus public, ownership. And then we will obviously conclude with what are the views on the markets and where are we seeing the markets moving on going forward. Moving to the next, we think we'll talk about the performance first. In the coffee can portfolio, for the month that went by, we obviously fell in line with the markets because unlike the last fall, this particular March month was obviously led by sell-off in large caps, particularly triggered by the US-Iran conflict. Our portfolio stocks, which obviously fell sharply, was Ashok Leyland, Interglobe, and Bajaj Finserv. Whereas, Zydus, ABB, and Abbott obviously did well compared to the markets. Despite the fall, over 1 year period, we are obviously, doing ahead of the benchmark. And we think with the recovery in the markets, this is obviously to come back even sharply as we can see in the April month so far. Moving ahead to the next portfolio, the good and clean, the same sort of situation out here. The fall has been quite broad-based. So we have seen, the losses into the extent of 18-20% in some few names, particularly the Chola, Canara, and Hindustan Copper. Whereas, Lupin, MCX, and IGIL did well from a absolute point of view. Despite the fall, I think the last 6 to 12 months, the the portfolio is done reasonably well compared to the markets, and our repositioning it from a very sort of mid cap focus to a relatively flex all cap portfolio has actually enabled this kind of comeback, and we think this will continue in the way forward as well, and we think the alpha will be significantly as we progress forward. Similarly, moving to the next, the micro cap portfolio, the micro marvels obviously also saw some sell-off in the month of March thanks to the external factors. Uh, However, the April has been even sharply better because the stocks obviously that got sold off in the month of March, thanks to obviously the February post-budget uncertainty in terms of STD, followed by the US-Iran sort of standoff, and few of the names that went down sharply even rebounded even sharply. So our view obviously is some of the businesses that are very unique and offering very strong earning growth are the ones in the portfolio that are seeing very sharp comeback as we speak in the month of April as well. This is a quick reflection on the performance. Moving to next, which is this is how we will move to, and we're talking about the pricing progress fund. So pricing progress fund is similar to, it's again an all cap EIF, which obviously had fell in line with the markets, and we think it will sort of move ahead based on our portfolio positioning. We will see the comeback even sharper in the month of April, and we think some of the names that we have used this volatility as an opportunity to add stock from portfolio in this particular fund as well. With that, we'll move on to the topic of the month, and I would like to hand over this to Sushant, who will take us through the private versus public ownership. Over to you, Sushant.
Thanks, Trilok. Thanks for the update on portfolio. Good evening, everyone. Thanks for joining in. We have a very differentiated topic this month on which we wrote our newsletter. I hope many of you have already read the newsletter. So we'll just, I would say, take some inputs from that newsletter to discuss. And towards the end, probably we'll have a Q&A on that as well. But the inspiration to write this newsletter really has been the behavior of shareholders, especially HNIs, ultra HNIs, changing over the last few years, which we have seen in the marketplace, whereby more and more, I would say, clients, prospects of ours have been talking about our views on few unlisted securities and the trends which we have seen in the marketplace, where there are many companies have a very large shareholder base. In fact, NSE, which is being the most talked about unlisted company, grown to almost 2 lakh shareholders now. Now, 2 lakh shareholders, something which many listed companies don't have. If you look at small and mid cap companies, their shareholders base is typically 25,000, 50,000 shareholders. Large caps are the ones which primarily will have a 1 lakh plus shareholder base. Right, a company either has a history of more than 20 years being listed, or they have done large caps, and that's why their number of shareholders are more than a lakh. So NSE definitely is a large cap equivalent company, but on the unlisted side, to have such a large, huge shareholder base, and we'll talk more about it during the presentation, is a real big trend change which we have been witnessing, and it's not just India. Probably globally, this trend has picked up where more and more investors are wanting to take a pie in the private markets and get their thesis right in terms of either a new theme going on, whether it's EV or whether it's in today's context, or probably sectors which typically you don't get to participate in on the listed side. That trend is becoming big. So we'll start with the presentation on that. So if you look at the context to that as to why it is happening so, and when you compare it with the PVC ecosystem over the last 10 odd years in India, there was a good growth between 2014 till 2022, right, where almost close to from $15 billion to about 50, $70 billion of transaction used to take place on an annual basis. But the last 3 years, that rush has probably certainly cooled off, where just about close to $40 billion transactions has taken place in each of the 3 calendar years, 23, 24, and 25. And it's not that the deal activity has probably slowed down. It's not that fundraising is not happening. Probably there is another source of capital beyond, I would say, the institutional investors, which are the VC and PE funds, which is the family offices and HNIs, which are directly now participating into this category as well. Moving next. Now, if you look at the PVC community in India itself, on the AIF platform, historically, private equity used to be owned by foreign investors, and there were foreign structures which used to invest in India in either a FPI or a FDI format. But increasingly, AIF has become, I would say, the real playground where even global investors are participating through the AIF route. And this is what we have seen over the period, that over the last 10 years itself, the number of AIFs into play have moved from 100 to 1600 plus. So almost 16x growth in the number of players, the number of funds itself, not necessarily the number of players. And the participation, especially on the P and VC side, which is category 2-1 and category 2, is almost 70% of the capital raised across AIFs. As late as December 25. This is, of course, cumulative. So 70% of the investments are happening on the private side within the AIFs as well. The Cat 3 AIFs are picking up well, but they are still just about 30% of the AIF market. And increasing another trend which we have seen, that the flows from global investors into these AIFs has grown from 70 to about 262,000 odd crores, which is almost 3x, 3.5x jump. But the domestic actually has grown really big from almost 100,000 to about 512,000 over this period. So that segment actually is participating real more. So it's a question what we are saying as to our investors moving away from listed to more and more unlisted. And we'll talk more about it as we move forward. Going next. If you look at what we did was we looked at some RHPs of companies which got listed recently, and also a couple of companies which have filed RHPs and are yet to get listed, like PhonePe and SBI Fund Management. Because in RHP, you get a detailed version of the shareholding patterns of each company and the number of shareholders. And we noticed quite a large shareholder base in many companies. So companies like Swiggy and Grow had almost 25 and 10,000 shareholders. Companies like Tata Capital and HDFC, not the HDB Financial, not the typical e-commerce company with a frenzy on the tech play, etc., but real bottoms-up play on the Indian economy. These companies also had almost 37,000 and 49,000 shareholders just before the IPO. And post IPO, of course, their shareholders have number has increased massively, probably 5x to 10x in each of these cases. But even before IPO, there were so many shareholders. Typically, you will find like when IPOs of Zomato, Nykaa, etc. happened, they just had a few shareholders. Of course, in Paytm, the number of shareholders were much higher. But it was more because of ESOPs being plenty than anything else. Um, and what we did was we also tried to see how much are people investing in each of these companies. So we looked at the IPO upper band of the price, multiplied that with the number of shares held by small shareholders, which are public shareholders and owning less than 1% of the company, and looked at per shareholder what's the value. In many cases, like Swiggy and Grow, it was about 75 and 45 lakhs compared to probably Ola Electric, Pine, Misho, where it was in multiple of crores, like 2.5 crores to 50 odd, 60 odd crores. Be it Urban Company, Brainbees, etc. as well. Uh, and surprising, both in Tata Capital and HDB Financial, these small shareholders were having an average investment of 9 lakhs and 6 lakhs as well. So probably it became from ultra HNI play to HNI and now probably affluent HNI play as well, where so many shareholders are taking a bet on unlisted companies. Compared that to NSE, it's valuing it at about 1920 per share, which is the price which we have seen in many unlisted platforms, marketplace. Available on internet, and even NSE, the small shareholders are now about 80 lakhs each. Of course, there are many shareholders who are owning 500 and 1000 crore worth of stock individuals, and that's why the average looks that high. But at a 2 lakh shareholder base, probably there are many people who are owning 5 and 10 lakh worth NSE stock. Even in SBI Funds Management, which has just filed its DRHP a few weeks back, even there the per investor share value basis the price available on these platforms, which is about close to 755 rupees per share. The average investment is about 13 lakh rupees. So it's more like a retailization of private markets, which is the big trend which is happening. And we believe that there are few concerns and risks which we need to evaluate. And that's why we wrote this newsletter, and we'll cover more of that going ahead. Move next. Yeah, as we were talking about NSE, and if you see, there is a sea change just in about last 12, 13 years. 13 years back in 2012, NSE just had about less than 100 shareholders, which moved to, by 2020, less than 500 shareholders. And as we speak, it's about 2 lakh shareholders. So there's been a big increase between FY20 and FY by December 2025, right? From almost 500 shareholders to close to 2 lakh shareholders now. So big jump, and we can see the participation also moving. That what used to be an institutional play of almost, I would say, 87% institutional holding has come down to almost 57% institutional shareholding between 2012 and 2025. And much of that has been built in the last 5 odd years. Compare NSE shareholder base, you'll see companies like KFIN and MCX are about 2.5 lakh shares holders, while CDSL, NSDL, and BSE are about 8 to 10, 15 lakhs. Right. And probably once NSE gets listed, which is expected later this year, this shareholder base from 2 lakhs might become probably 15, 20 lakhs very quickly as well. Moving next. And as we've seen that there's been a big IPO boom for PVCs as per the IVCA data available published by them. This has been the trend that there has been so many IPOs exit for all these PVC. But one interesting trend we are observing from the data which we have seen is the average IPO period actually is moving up from about 10, 11 years from initial funding to about 13, 14 years of from initial funding. So IPOs are getting delayed. Both, I would say, as a clause, I would say, as a reason behind the profitability getting a bit delayed, and the public market now wanting to invest only in companies which have turned profitable. Remember in 2021 when we had the first wave of IPOs on tech companies, most of those companies were having unprofitable businesses, and there was a, I would say, a shadow of profit which was seen over the next few quarters. Moving from there from 2021 to 2025, all the IPOs which have happened, these companies have turned almost profitable, probably on a quarterly basis, if not yearly basis. And if the experience, which was quite bad for public market investors just after the IPO, when there were drawdowns between 30 to 70% of many of those companies, this time, so far, I would say there has been not been severe drawdowns, but time will tell. If there are again, I would say, big drawdowns in the next 6 to 12 months, then probably the street will need the businesses to be profitable for probably more than a year, and not just for a quarter before they get listed. I think the bar is getting raised every passing cycle in this segment. Moving next. So as we and also I would say the one typical observation is that the IPO's window, it opens and shuts. It's not that IPOs don't happen, but if you look both on the basis of deal value as well as the number of IPOs, and these are the number of IPOs including SME IPOs as well, because there is no distinction between main board and SME on Bloomberg, from where we pick that data. But at least the trend is quite visible that there was a good window which opened up in 2017-18, and then again there was a lean period of almost 2 odd years, and then there was some pickup in I would say late 21, when there are few IPOs which happened, 50 plus IPOs every quarter for 3 4 quarters, and then again I think it settled at those levels for another 3 4 quarters, and then the activity picked up in 2023, late 23, and has been quite active since then. And as we have seen that probably March quarter again, already the number from September, which was almost 200 IPOs, has come down to 80 IPOs. And even if you look at the value perspective, the $1.6 billion has come down to 544 million sort of number. Moving next. So, what are the reasons why people are increasingly interested in private markets? So, we spoke to quite a few investors, we spoke to few bankers, and the key factors which came to from those discussions were that one, IPO tend to deliver superior returns. There is a big alpha, but that is more, I would say, more expectation than a broad-based. The median returns from private markets are probably lower than median returns from listed markets, but the expectation of generating the superior returns. And there lies, I would say, that information asymmetry is a primary reason for behind that, that only the winners are visible to anyone and not the losers. So we all hear about the unicorns, we all hear about the big fundraisers, but what we don't hear about are the companies which were not able to raise even Series B or Series C, or probably Series D and Series E after a successful Series A, B, or C. Right. But the general expectation why people do invest in these private markets are to get in early and create a huge superior return profile, even if they get one out of 5 or 10 bets right. Then, as we discussed earlier, the diversification beyond the index, that what you don't get in public markets, you are able to access in private markets, be it some new theme, let's say an AI theme right now, or probably a renewables theme sometime back, or a defense theme before that, etc. So there are many private players which are available at that time, which are not necessarily accessible to public market investors. And definitely early access to future blue chips. NSE, I think, is a big example of that. That it's already one of the best companies in the country in terms of profitability metrics, in terms of growth metrics, and being in a sort of a regulated environment where there are not too many exchanges which will come to get into them into an early phase, both from a compounding perspective, because the earnings are getting compounded, as well as I think getting them in too early, so that the superior growth phase is something which is being participated by investors as well. And beyond that, I would say two journalistic factors. One on the influence and information. Being public markets, you don't have any board seat, you don't have any probably information rights, which you get to know more. So many investors do invest for those reasons as well, beyond the return side. So there is beyond returns, I think the ability to get into a business and influence the decision making as well as to know more and more about that sector is more available on private side than on the public market side. And definitely, many of these businesses are getting funded by institutions, be it VC funds or private equity funds at a later stage. That gives, I would say, some participation kick to investors as well. That getting into these companies are as similar to private public market investments because they've already been diligent by institutions. So by getting into these companies, they are not taking undue risk because both the business model as well as their governance has been diligent by the institutional investors. Moving next. So then, if these were the reasons, then what are the key risks? So what are the risks we see when we looked at the space? There were a few key risks which we wanted to highlight. First and foremost, I would say the liquidity and the exit risk. Given that there are private market transactions and there is no interface between buyers and sellers marketplace, while there are few websites which have been acting as marketplaces, but they have been recently SEBI came out with, I would say, a circular saying that these marketplaces are not regulated entities and one needs to be careful. And we have seen that IPOs, as we saw the data earlier, do come in windows. So not necessarily that when you get into a private company, you'll get an exit in a year or two or three. It might get delayed. So there is a big liquidity risk because there is no ready-made market of buyers and sellers which is available, unlike listed markets. Second, of course, the valuation uncertainty because the pricing at which the transaction happens, they are not necessarily, I would say, informed or efficient pricing because these are counterparties which might be doing the transaction at different prices at different points of time and also at the same time at different prices between different parties. So there is a lot of, I would say, uh, and also because of lack of information of data, how the valuation has been arrived of these companies is also quite uncertain. So there is a big risk in terms of what valuation one is paying, both for entering as well as exit. It's not just about entry point. Even when if you are exiting within when the companies are still private, there might be a price risk to that because the pricing is not efficient, which is available for everyone to participate, like a listed stock exchange. Again, there is a big lock-in risk. So once a company gets listed, then the shareholders, especially non-institutional shareholders, they have a mandatory 6-month lock-in just after the IPO. And one cannot participate even if the stock has gone up. And we saw what happened during for Swiggy or Ola Electric and many such cases where the prices went up post the IPO and the listing price, and the retail shareholders were not able to participate because they had a mandatory lock-in and they were not able to get out, and they had to probably get take an exit at a later stage at a lower price. Who knows when time comes in the next few quarters or years, there might be a better exit point, but then there was a better entry point as well for those, I would say, discussions. Information asymmetry, I think this is the biggest risk one is taking in private markets because one can choose what to show and what not to show to an investor, especially non-institutional investors on private markets. They have very limited access to information in a private company. And that I would say is a large, big risk which is there. And one always takes a leap of faith while getting into or getting out of these companies basis whatever information is available. So there is a big information asymmetry between institutional and non-institutional shareholders. compared to, I would say, public markets where the same information is available to all the investors, whether they're institutional or non-institutional. So typically, I think while there are risks to private markets, in case of non-institutional shareholding, this is one of the biggest risks which is there. And counterparty risk, of course, I think unlike stock markets, listed equities, where there is a great governance and regulated framework where to ensure that there are no, I would say, mess ups which happen. And one, if one has sold, then they will get the funds, and if one has bought, then they will get the shares once they transfer the funds. In case of the unlisted transactions, because those are over the counter transactions and negotiated transactions, bilateral transactions, that risk is quite high, which is the counterparty risk. And we have seen what happened recently in NSE, and we read about the ED case of more than 1,200 crores worth of scam, which happened amongst various entities, which probably took money and failed to deliver the NSE stock to their investors. I think it's probably almost 1,200 crores worth of transactions which happened just a few months back. And so that's a big, I would say, risk, which, and especially for non-institutional shareholders. And from information asymmetry, we saw what happened in Byju's. Everybody leapt in on the stock, became from probably nothing to $1 billion to $22 billion. Many family offices, many HNIs, both in India as well as globally, participated in that. And the business just went off to almost, I would say, an insolvency stage. And definitely one part is the concentration risk, especially when you are a non-institutional shareholder and you are taking some bets. There is a limit on the number of bets one will take. And many times you get into one, two, three, five investments, and that becomes a huge concentration risk. For non-institutional investors. Of course, being an institutional shareholder, if you participate from an institutional route by getting into as an investor into a VC fund or a private equity fund or a secondaries fund, that risk is probably, I would say, taken care of. But from a non-institutional shareholder perspective, investors perspective, I think there are few risks like information asymmetry or a counterparty risk or a concentration risk, which is there. Anyone lock-in risk from that perspective. So many of these risks, I would say, can be negated by getting into a regulated structure like an AIF rather than directly participating. Moving next. Yeah, so I was coming to, probably I've covered a large part of this already in my discussions in the previous few slides. But there are definitely between how you get into a private market transaction, whether as an institution participation, becoming an investor in AIFs, or doing it on your own. There is, I think, a lot of difference, and there is merit in becoming and participating more as an institutional shareholder than as an individual shareholder. And a few of the differences are, one, I think we talked about concentration. So there is definitely a diversification opportunity which is available if you participate as an investor through an institution. There is a good amount of diligence which takes place, which is, I would say, available for institutional shareholders to conduct compared to, I would say, individual shareholders. Of course, large family offices conduct themselves as institutional investors, and probably they will be able to do that. But for affluent HNIs and HNIs, probably they take more leap of faith than diligence. And even if some institutional shareholders are there piggybacking on them, then definitely, as we discussed, the IPO exit, that institutional shareholders have no lock-in if they have been invested for more than 6 months before IPO. Uh, but non-institutional shareholders have to have a mandatory 6 months lock-in even after the IPO. So liquidity gets, I would say, impacted, as well. I would say the price discovery just post IPO, the benefit of that is not available to non-institutional shareholders. And definitely from a pricing perspective, because it's more negotiated transactions, the leverage which a buyer has as a non-institutional shareholder versus an institutional shareholder is very, very different. And one is probably able to better negotiate as a professional institution compared to an individual as well. And it's applicable not just for entry, but for exits as well, many a times. and definitely the risk of liquidation priority or governance or a minimum ticket size. Because doing a private transaction, especially, one might need to shell a larger amount compared to in just investing into a fund and getting access to 10, 15, 20 investments through that. So with that, I think probably I'll request Trilok to discuss more on macros. And while we discuss how unlisted markets has become frenzy and more people are participating in that, and it's probably quite lucrative. But given that what has happened in the past few months or probably past few quarters as well, that we believe that there is a big opportunity which is staring for public market investors. And I'll request Trilok to decipher that for us.
Thank you, Sushant, for the wonderful insight and what kind of necessary approach should be taken before anybody seeks out of private investing. I think, as you rightly mentioned, this public versus private, public plus private will always continue as a debate. But more importantly, we think, given the market backdrop and the recent uh, global sort of unrest, we think this is a fantastic opportunity in the market to invest, and we believe this is one of the rare, very few opportunities in the last several years that has come across, and that's what our experience suggests. We'll move to the next. First and foremost, I think so. The bigger question that everybody in the room has is why the FI is selling. Moreover, is the only country where the flight of capital is prevalent? The answer is fortunately no. Most of the countries similar to India is seeing a massive outflow in the last several years. Moreover, if you look about this, tried to create a data for the last 15-20 years. The last decade, 2010 to 2020, India was the largest recipient of FII capital. If you look at the last post-COVID, most markets, including India, has seen an outflow, except for except for Brazil, because that's a more agri-dependent sort of country. So the question about FII sell-off is not very constrained to India, but it's a global emerging market sort of backdrop. And the biggest reason in our understanding is obviously the US, 10-year bonds. The US 10-year bonds have rallied from almost virtually 0% to nearly 4.5%, 5%. So the cost of capital for the FI has gone up by between 4 to 5% in the last several years. And that's exactly one of the biggest reasons why we are seeing, outflow across emerging markets. Moving to next, if you look at the emerging market premium of India has also come off, and now we are trading at a significant discount. I mean, I would say the premium has shrunk meaningfully over the last several years, and currently we are obviously at very marginal premium compared to last 5 and 10 year averages compared to MSCI. Moving ahead from emerging market comparison to next, this is one of the important things that we also highlighted even last time, that with the uncertainty sort of dragging the markets, the recovery is even sharper. The average, so we have taken a several last 40 years of history in terms of various external factors that impacted the market, and we have seen average drawdown between has been between 8 to 10%, but obviously the recovery has been even sharper, and average recovery is less than a month time frame, and in the next 2 months subsequently the market fully recovers whatever they've lost. So we think this time also it will be no different, and April so far has demonstrated that kind of recovery so far, and we have already seen nearly 50% of the lost money in March already recovered until April 16th. Moving ahead, if you look at, this is one of the important factors in India. I mean, in global markets for that matter, only three things matters. One is earnings, second is valuation, third is liquidity. In my opinion, earnings have, in India after a long period of downgrades have bottomed out. In fact, this is the quarter that went by was the first quarter where we saw earning upgrade, and we think Q4 also will be better than most people are expectations. And in context of the crude at $90-$95, we think initially Q1 could be relatively sort of soft, but we think the full year you will see only upgrades of cycle happening rather than downgrade, because people have already taken a very sharp sort of estimates revision post the US unrest happened. Moving ahead, we think this is, I would like, Sushant to sort of, throw some lights on this data point. I think that this we are trying to highlight about the longer term, returns of the Nifty and the Nifty 500. And Sushant, if you help us understand this slide, please.
Sure. So what we did was we tried to see rolling returns of Nifty and Nifty 500 on a 5 year and 7 year basis to see how they peak out or gets into trough. And we saw that if you look at the 5 year return of Nifty over the last 25 odd years, and we basis that 25 years, we created a 20-year rolling chart from 2005 to 2026. Right. And we see that whenever Nifty 5 year return goes into a single digit trajectory, that's when I think the market sort of turn and give quite interesting returns to the shareholders. And as you can see, currently we are at close to 9% as of March end. Of course, market have rebounded quite well in the last a few days, a couple of weeks. But if the market continues, I would say at these levels, Nifty being at 20,500 to 24,500, which is where it is currently, right? Over the next few months, we see that basis the 5 year CAGR, the returns will still be mostly single digit or just about double digit, right? And what happens once the stock, I would say the indices give a 5 year return of that trajectory? Go to the next slide. Yeah, and this is the data on those periods during which the Nifty 5 year CAGR returns were single digit, right? And those dots represent the percentages, which is on the right hand side axis. That you can see that the top percentage on that is 10. So all those returns are during the time period when the Nifty 5 year CAGR had gone down to a single digit, right? I think only twice it had gone closer to zero, which was one between during 2013 crisis and then COVID briefly as well, right? Many times it was between, I would say, 4 to 8% as well. Like that's where it went. There were many instances, mostly around that level. But whenever that happens, the next 12 and 40, 24-month returns, right? So if you look at the light green, which is sort of a 1 year return, it is as high as probably 92%. And if you look at a 2 year return, which is a CAGR return, it is as high as 47% in these cases, right? On an average, the next 1 year returns are 28% for Nifty, and on a 2 year basis, about 26%. So markets bottom out once they become single digit, many times probably between 6 to 8%. And we have seen that if market remains in between around 24,000 range Nifty, then those returns will hit in the next 4 5 months at that point, which is mid single digit. And from there, the rebound is about 26 28% on an average on a median basis as well, because averages count both maximum minimum. Even on a median basis, the 1 and 2 year returns are 21% and 23% CAGR. So quite meaningful, quite attractive returns, and which is what we believe that is the situation of the market. Every time the returns comes down to a single digit for a reason. This time it is because of the US-Iran-Israel standoff. Previously, it was because of COVID. It was because of the European debt crisis, because of global financial crisis, because of the dot-com boom getting busted. So every time there is a different reason, but the outcome is quite follows a similar pattern, where once the 5 year return goes down, then the next 1 and 2 year returns are really, really attractive and time for people to cover up, I would say, both for the last few months of, and we have seen in the different chart that after 18 and 19 months, this is what happens, that the markets rebound, and 1 and 2 year returns both that are quite attractive. Move next. Yeah, and similar in, I would say, Nifty 500, again, similar, that once it reaches about 10% or below return, this is what happens. Again, here the median, in fact, is much stronger, 23% on a both 1 year and 2 year basis. So, which means that mid and small caps also do well on a 1 year, 2 year basis. Yeah. And again, I think the market valuations are quite attractive. As of March end, the valuations were on a rolling 5-year basis. Nifty 500 returns, if you see, had come down to almost 21 times compared on a trailing basis versus a 5-year average of 26. And so is the case with mid cap index and Nifty as well. The only joker in the pack, I think, is that small caps are still trading around 5-year average, but that's because we had a wonderful, I would say, rally on the small caps so over the last 5 years. But they are also have now at the average level, and definitely, I think in next few months, it is if it remains the same, then there will be interesting opportunity even in small caps. Moving next. Yeah, and this was a chart where we're seeing earlier that for 18-19 month period, if the markets don't deliver any meaningful returns, which means the markets are flat, they either go down or go up and then come back to those levels again after 18-19 months. This is what happens. There are up to instances, as was seen in the chart which we showed also in on a tabular format. You will see again that similar things happens that the median returns is about 35% for small caps for next 12 months. For Nifty 500, it's about 19%, and for mid cap 100, it's about 33 odd percent, and for Nifty, it has been about 17% in these situations. That when for 18-19 months the returns have not gone delivered, then the next 12 months and 24 and 36 months are quite attractive for investors.